There's something called the efficient market theory, which says that there's nothing in the data, let's say price data, which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price.
Asset prices reflect all available information. That's the efficient market hypothesis. A direct implication is that it's impossible to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information. But, as stated by Jim himself, you find people beating the market all the time. Even the creator of the theory himself said, yeah, it's probably not 100% true. So what gives? What's the point of the theory? I think it's a valuable thought experiment which can turn you into a profitable trader if you take the concept seriously. It's not just something to entertain as some abstract notion, but a way to test predictions on the market empirically. The concept goes back to early statistics. Louis Bachelier was the first to formalize Brownian motion in math, which, when brought into modern finance, basically said stock prices move randomly. The idea is simple. If prices are constantly hit by countless tiny independent shocks, stuff like news, trades, expectations, then each small move is essentially unpredictable on its own. Stack those tiny directionless moves together, and you get a quote-unquote random walk. The next step's direction isn't something you can forecast from the last one, even if variance grows with time. Eugene Fama comes along and consolidates everything into a structured theory with 3 different definitions. Weak form includes price information, semi-strong includes price information and public information, strong includes all information, including insider information. Here's where the idea gets interesting. Not only is it now a way to test predictions, like how quickly and accurately prices react to new information, but it can also provide a benchmark. If markets are efficient, what should returns, strategies, and valuations look like? A deviation from that benchmark can suggest outsized returns. All in all, it's an attempt to formalize the idea that security prices fully and quickly reflect all available information. Okay, so I know what you're asking. How do I make money with this? To answer that, let's go back to a paper I wrote at uni. Yeah, I've studied this topic in a lot of depth, so you could trust that I know what I'm talking about. Most of it. Using this plagiarized model, I basically asked if this deregulated London Stock Exchange market for smaller companies, also called the AIM market, shows evidence of weak form efficiency. Skipping over some math that I don't even know is correct in retrospect, I'll read out the line that summarizes this paper best. Quote, "Even with dire returns, high levels of underpricing, and information asymmetries, the AIM is an efficiently learning market translation. Even in this market, with these piece of shit companies, prices reflect all historic price information. So, strategies that just incorporate prior price action could be less likely to work since it's already incorporated into the current price. Let's use something more recent. This 2025 paper title is All the Information in the Price. The authors take a strategy, in this case price-based clustering, and find that it can't be improved even using AI for all publicly available information. As the paper itself states, this provides empirical evidence reinforcing the idea that short-horizon return information is largely contained in the prices, which, in effect, supports the efficient market hypothesis as valid, at least the weak form variant. But there are gaps here. These are stocks in the S&P 500 over just 2 years. What if you apply this methodology to other markets and timeframes? The study itself actually shows you how to do it. This is where you can find money in the market, as it reveals real arbitrage opportunities that are still out there despite what you may hear. Understanding market efficiency lets you understand the market in a deeper way than you might initially think. By skipping all of this and going straight to, obviously markets aren't efficient, you are missing the step which could actually turn you into a profitable trader. Obviously, they're not perfectly efficient. It really doesn't take a genius to see that, but the question is, in what ways aren't they efficient? What could this research tell you about the markets? These are questions that I think are worth asking.